Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. We're excited that you're part of our journey. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We've got a returning guest, a favourite here from Fidelity. His name is James Abela, and he is on the hunt for the future leaders of the corporate world.
Yes. Now, this kicks off our series with Fidelity, celebrating the launch of their active ETFs that not only cover global small and mid caps that we'll be talking about today, but also India, Asia, and concentrated Australian equities. But Ren, as you alluded to, today is all about the Fidelity Global Future Leaders active ETF. The ASX ticker is FCAP.
Yeah.
And we've got James in here to unpack it all.
Yeah. Stoked that we're getting more of these active ETFs to market. Like for retail investors, who used to have to deal with high minimum investments, now these ETFs are as accessible as buying a stock through our brokers. So it's great to see they're becoming more accessible. So we're very excited to celebrate Fidelity launching on the ASX. And James always comes to us with very interesting companies.
Yeah.
And I'm sure today will be no different. We're going to unpack his investing philosophy. We're going to talk about, I guess, what makes a global future leader. And importantly, what are like the features, the hallmarks that stand out in a company's numbers, or, like what they're doing that shows, okay, there could be something here. But then we're going to get to two stock deep dives where James is going to bring two future leaders to the table.
Yeah.
So I'm excited for that.
Me too. Cannot wait to get stuck in. Always love chatting to James. We should say thank you to Fidelity for supporting this series and allowing us to keep content free for the Equity Mates community. A reminder that on Wednesday, the 10th of July, we are coming to Melbourne to do a live podcast. We cannot wait. The evening is going to be highlighted by a live Pimp My Portfolio session where Ren and I will be going through our portfolios, every single position, with Luke Larrative to get his thoughts on how we might be able to improve our portfolios, just like we do it with community members on the show. So if you want to see what is in our portfolios and see if Luke can roast us, then come and join us at our live event in Melbourne. We're also doing an Ask an Advisor session as part of it, where we'll be bringing in Dylan, one of our advisors, where you can answer all of your questions from the night, as well as we'll be unpacking the news headlines just like we normally do on the show. So come and join us. It's Wednesday the 10th of July. Tickets are available at equitymates.com/events. I think there's only about 20% left or so. So make sure you grab one. We cannot wait to see you there. But Ren, without further ado, let's get stuck into it. Well, James, welcome to Equity Mates.
Thank you.
Good to have you back.
Thanks very much.
So we want to start off with your investment approach. How would you define your investment philosophy?
Look, the investment philosophy is really, it's quite based on numbers, but it tries to be very balanced. Because when I started at Fidelity as a PM, interviewed a whole lot of PMs that have been around for 20, 30 years, and they said, look, just always try to be balanced. Don't try to be extreme quality or extreme momentum or extreme value, because that's where you get caught out in the cycle. So my process is therefore a very balanced perspective of quality, value, transition, and momentum. And that's how the portfolio is structured. But it is very balanced in that sense. It's 40, 30, 20, 10 across those kind of groups. And the psychology is very much like your brain as a human being thinks quality gets you very relaxed. I'm in love with the stock. It's high ROE. It's high return, high growth, high multiple. It's all good. And as your brain goes into these different, I guess, paradigms of investing, quality, value, transition, or momentum, you get caught up with certain blind spots. So you've got love spots and blind spots because everything's going well, but then it also blinds you to what doesn't go well. So for me, that's why it's always try to be balanced, but then always be aware of the positive and negative in those 4 quadrants.
So quality, value, and momentum, people will likely have heard about before.
Yep.
Quality is, I guess, the aspects of the business, like the long-term sustainable competitive advantage.
Yep.
Value is about the price that you're paying versus what you're buying.
Yes.
Momentum is the share price movement.
Yeah.
I haven't really heard a lot about transition.
Transition is a positive and negative group. So the negative groups are quality, fallen angels in quality, and fading momentum out of the momentum group. And then you got the positive ones, which are catalysts that sit in transition, but they have real catalysts that you can see.
So it's like a change in the business.
Positive changes, positive. So the negative changes are fallen angels and your fading momentum stocks, and the positive change is your real turnaround stories.
Okay.
So it can be restructuring, cost cutting, some big things that are visible, and often management provide you with milestones. And that's how you classify that in that group.
Yeah.
To put you on the spot, is there a recent example that, like a stock that is in that quadrant?
Yeah, so there's one really good one was Texas Pacific Group. It was actually an oil business in the US, and it was an old, boring trust, basically. It was very established, hadn't been challenged for decades, and then it turned itself into a company through an activist. And going from a trust to a company, the board all changed. They became more shareholder friendly, and the stock went up 300%. On that catalyst.
Wow.
Right? And it was very visible. So there was an activist got a block, activist changed the board, activist said, right, got to be shareholder friendly, and then everything just happened. The rest was history, and it went up 3x. It was obviously when oil was going well, but that was a tailwind. But still, it was the structural change of that. That caused that movement. And that's what a classic transition stock is. And we'll be in them for typically 12 to 18 months.
Okay.
And they'll be typically 3x.
Typically 3x.
Yeah, that's what the history's been. There's 5 examples of that. And
wow.
Yeah.
Wow. Okay.
Nice.
So you are the co-portfolio manager of the Fidelity Global Future Lea's active ETF.
Yes.
Which I think is exciting because last time we spoke, it may not have been an active ETF.
No, it was just the fund at that stage, the Aussie pool.
So we love that, more accessible for everyone.
Yes.
And I guess we want to unpack some of the elements of what makes a global future leader, because that's what we're all looking for. We're all looking for the next big thing.
Yeah.
So there's a few elements that we pulled out when we were researching this episode: a strong competitive positioning, sustainability of business model, and reinvestment runway.
Yes.
And so we want to take them one by one and sort of get your thoughts on why they're important, and then also how you find those features in the companies you're looking at.
Yeah.
So let's start with strong competitive positioning. What are the hallmarks of a strong competitive position, and what are the signs that a company has it?
Perfect. Yeah, that's a good way to think about it. So typically it's small market structures. So small market structures where you could basically fit the industry on the palm of your hand.
Okay.
So when there's a problem in the world, as a human being, a company or an organization, you want to solve a problem, there's only 5 places or 5 companies in the world that you'll go to. So ResMed's a good example of that. Some brands in the world are like that. Some technology providers are like that. And some service providers are like that in terms of industrial service providers. In many cases, there is deep elements of trust and deep elements of history that allows you as a human being or a corporate making a decision to allow you to go to that place and feel comfortable that that is going to solve the problem that you're trying to solve. That's typically the characteristics. How you see it is the return profile. So high ROEs, very steady growth, very high what we call persistency or consistency. So your ROE, return on equity, might be 15 to 20% for like a decade or sometimes 2 decades, which is very rare, actually. They're quite rare. And in our universe and in the Aussie universe, true quality is around 12 to 15% of the listed market. It's quite small.
Yeah, okay.
So they're 1 in 7 to 1 in 8 companies in the world. But you'll see that very consistent return profile. Remember, the average Australian company or even global company has an ROE of about 8.
Yeah.
This is like 1.5 to 2x that. But to have it consistently is also quite rare. So that's how you get to those sort of lower ratio numbers.
Yeah, and I guess to unpack that, the reason why the consistently high ROE is a sign of strong competitive positioning is competitors haven't been able to come in and take that market share or
Correct.
reduce prices.
Exactly.
Yeah.
So they have pricing power, depth of trust, depth of relationship, all these things, depth of time, and they're things that you can't just create.
Yeah.
They, as a human being, you go to those companies because they've proven to you as a buyer over a decade or two that they can do it.
Yeah.
Whereas, developing an app or something that's short term, it can't give you that kind of profile.
Yeah. Yeah.
What about it when it's the other way? You're looking at a company that's trying to break into an industry where there's only 5, you can count them on their hand. Like you're looking at an industry that has strong competitive advantage because there's only so few. Someone's trying to bang on the door and get in there. Like how do you look at that and assess that company?
It's usually a momentum stock that's trying to get into a quality business, but that's something you got to be aware of when you think it's a great quality business. Like as a quality is like a long-term marriage, you think it's beautiful, it's protected, it's kind of going to keep you safe at night. But this is business. It is competitive. People are trying to eat your lunch every day of the week. People are trying to innovate their way into your market all the time. So it's typically a momentum player or a disruptor that's trying to break that quality kind of moat.
Yeah.
And that's how you'd look at it. And that does happen. That does happen. And that's just the nature of business. And humanity is very innovative. So obviously a lot of tech companies that have innovated and broken through very established networks. So you've got to keep your eye on that because, like I said, a high-quality business, you can be blinded to those things, but they do happen.
How do you assess the sustainability of a business model?
Yeah, pretty much sustainability, you got to look at the ESG elements first. So there's modern slavery and diversity and making sure that they're treating their employees and their sort of market structures right. Secondly, there is the sustainability of how they treat their customers and really suppliers. And that is a function of, for us, it's like 5 to 10 years of a sustainable return profile means that they are doing that.
Okay.
But it needs to be 5 to 10 years because otherwise it really is too short. But the sustainability is very, very important because that means if you can do it for 10 years, you can generally do it for 20. But if you can't do it for 10, there's either a cycle or it's not as great a moat as you think, or you're doing it in a way that's not sustainable. So that's either your kind of your environmental ESG kind of credentials. They are very important if you want to buy, especially a quality business that you think is 5 or 10, 20-year investment. It's very important.
Could you bring this sustainability of business model idea to life by a company that you think doesn't have a sustainable business model? One that you looked at and you're like, nah, there's something here where I'm not super interested.
Look, there's a lot of tech companies that have been really high flyers. So things that are up 5 to 10x at the moment in our universe that they have a concept which is working, but the history of it may be only 4 or 5 years old, or they may have made losses 2 years ago and today they're making $1 billion, right? And you just think, that doesn't really define sustainability to me. That's momentum. It's successful. There's no question about it. Otherwise, it wouldn't be making $1 billion today. But if it makes $1 billion today and it made losses 2 years ago, then what's happened? And is that billion sustainable? And that's really, I guess, what you got to ask yourself. So that's why that is real momentum, and that for me, it defines momentum. But they can really get into the quality market and really disrupt it. So you got to keep your eye on them all the time.
When you're looking at small caps, though, like the time period that you have with some of them might not be that they've had 25 years of history to look at. So how do you then weight a sustainable business model against, this is a company in its early years. We're looking for future leaders here.
Yep, true.
And sort of the play and the dynamic there.
Yeah, that's a very fair point. I'd say the Aussie market, and I've done studies on this, I call them toddlers. Like, look at the toddler index. So how many of them are under 3 years old? Literally 3 years old. And when markets are hot, that can get up to 40% of the market, which is a huge number.
Okay.
And the average age might be between sort of 5 and say 15. So they're really young to teenagers. In our market, because it's a bigger market, it's between 5 and 50 billion US. These are much more mature, so 30, 40, 50. One of them we own now currently, Moncler, is 70 years old. Right. So that's quite mature compared to. But it's a very fair point you make, and you do have to when you are finding future leaders, you do have to be aware that momentum may come and momentum may be innovative, and you need to acknowledge it, that visibility is something that you might only be able to see in the future, not right now. Yeah. It's not rare, but stocks can go from a transition momentum to quality. It does happen. You need to be careful that it's not cyclical. But if it is structural growth and it is innovative and it is, like you're talking about, disrupting the quality sort of cluster that exists today and in the past, and it's something that's going to be the leader of the future, hence the future leaders, then you need to just acknowledge it. And you need to buy some of those things, like we do own some of those things that were early stage. It's just that they're not quality when you look at them, but they may be quality in 5 years from now. So, yeah, it takes a bit of trust in management and understanding of the market and thinking about what they actually offer the market to actually accept that is what will happen in the future, as in you can't see it now, but it will happen.
I mean, in our lifetime, we've seen plenty of companies go from transition to momentum to quality.
Yes.
Not necessarily small caps, but like the biggest company in the world,
Yes.
Apple, was transitioned with iPhones, like a new product, completely new business. Then momentum, they ripped.
Yeah, massive market share.
Yeah, now their quality. They also still seem to be momentum. But yeah.
Yeah, it does. It does happen, and that's why you need to keep an eye on it, and you need to be aware, because your brain needs to shift, and you think, oh no, it's too hot, or it's momentum, so I'm not going to own it. Like, as long as your brain has the ability to move and also look a few years out as well, it's very important to do that. Otherwise, you will miss a lot.
Yeah, I guess the real analytical framework, the analytical challenge would be when to move. Like, I'm thinking about the hottest stock of the moment, Nvidia. Like, transition happened, AI became a thing.
Yep.
Momentum is well and truly here.
Yeah.
And like, there would be people that argue that Nvidia is quality, but it's like, is it, or is it just still riding a momentum wave that will stop at some point?
Out of our market cap league.
Yeah, I'm not asking you to.
Yeah, but
the
question is still there, and you got to look at what the PE. What is, again? You come back to what is sustainable. What is a sustainable return profile? Is it short term? Is it cyclical? Is it structural? And you got to ask those questions, and that's what you got to do in your head. Doesn't matter what market cap or if momentum to quality, you got to put those questions into your head. Is it structural? Is it cyclical?
Yeah.
What is sustainable? And how long is that duration period like? Is it 3 years, 5 years, 10 years, 20 years? If you can get comfort that is a 5 to 10 year duration and that return profile will be 15 to 20, that is actually a quality business.
Yeah.
And sometimes it doesn't. It's not always obvious. Not always obvious. And that's what. That's why you got to just keep your eye on these things and watch and ask a lot of questions, because the people in the industry know basically what's possible, and the market will have its own dreams and aspirations. But the more you talk to people in the industry, you'll get a better feel for what actually is real on the ground.
So the third element was the reinvestment runway.
Yes.
So I think what we want to understand here is, how do you know if it's just a small, profitable, nice little business like Equity Mates, or or it actually has the potential to reinvest effectively and grow into a global future leader?
Yeah. It comes back to like adjacencies of product or adjacencies of markets, or scope of market. So a lot of them are obviously American-based or European-based, and then they're going global. But once they have a runway which allows them to either go into adjacencies in product or adjacency in markets, they will continue to reinvest in that. And as long as that reinvestment rate can be at the same sort of 15 to 20% ROE, and they're not getting to what you call diseconomies of scale. So when you're, say, an Australian retailer and you have maybe 100 or 200 stores of a certain concept, and then you go into 300 or 400 to maybe get rebates or scale from your suppliers, that's getting into diseconomies of scale, because you start to get a lower incremental return profile. But if you are genuinely innovative, wherever you come from in the world, even Australia, and you can go into product adjacencies or market adjacencies and invest at that higher return rate, then you've got a pretty amazing business. And you've had it here domestically. You've got realestate.com.au, James Hardy, ResMed, Car Sales, and Seek have all, a lot of them have gone global, and they've reinvested at double-digit rates, 15 to 20% ROIC. Wise Tech. So a lot of these companies have been very successful globally, and global future leaders, very similar to the domestic future leaders, is they are European or American companies that typically start on the east or the west coast or Europe Central, and then start to go all around the world and export their concept. And when when you do that, it's amazing how many years you can have. Like I mentioned, Moncler is 70 years old, but most of the companies around 20 billion are 20, 30 or 40 years old, and they've had this runway for 20 or 30 years, which is phenomenal. Because most companies on the American market, the average lifespan is actually about 15 or 16 years.
Yeah.
So to actually reinvest for almost twice that for these successful companies is quite a phenomenal start.
It's a challenging one because when you're trying to assess like a domestic business that's super successful, time and time again, we've spoken on the show about these companies that say they want to grow and product adjacencies and some of the examples you spoke about.
Yeah.
And then it's just an almighty fail and they wind it down and come back to just, so I guess trying to, that's I guess the point of your job is to find the ones, find the ones that do well. But as an investor, if you're like, all right, it makes sense what they're trying, I'm going to put my money with them, and then lo and behold, 5 years later, it's all been a bit of a disaster.
Yeah, there's been plenty of Australian companies go offshore and come back, with their tail between their legs, and then write off $1 billion or two.
Yeah. So are there like traits that you've identified that kind of you can recognize that they are going to do?
There are traits. Yeah, typically they go a bit smaller and they do it organically. They're typically the ones that do better, and they're very niche. Actually, similar to equity mates, it's very niche. Like, it's a real specialist. There's a deep element of trust or a deep element of specialization. They're doing something a bit different. And when they do that and they do it kind of slowly in a new market, and then they get accepted and then they start to penetrate that market, that's really how you basically become, globalized.
Yeah, nice.
Whereas if you try to make a big acquisition, that typically doesn't work well. Most of those with tail between their legs have done big acquisitions, and they call it transformational acquisition, and then it just doesn't work. So mostly organic is better.
When I think about reinvestment, like reinvestment can come in multiple different forms. You've got like a ResMed, which is like we've got something that works and we're just going to take it global.
Yep.
Or you've got a WiseTech, which is like we're going to acquire and we're going to acquire and we're going to acquire. And for WiseTech, it's worked. Or you've got like an Audinate who's like, we've got a product adjacency. We're good in audio. We're now going to try and do the same in video. Are there like particular forms of reinvestment runway that you prefer to see? Like potentially like the ResMed, like we're just going to take what works and make it global? Or like will you take reinvestment in any form and it's like about the idiosyncratic company execution?
Yeah, no, it's definitely very important to think about this. And the key thing is what you said, ResMed, that's the easiest and the lowest risk format, is following the same product but exporting it into a different market geographically where there is a genuine need, and you are doing something different, and therefore the uptake is generally quite high.
Yeah.
In particular for ResMed, there's a big element of trust. So that's the biggest one. If there is a big element of trust or a big element of specialization, that tends to be where the success rate is the highest. So like ResMed, for example, that one, if anyone of us or kids or partners or friends go into hospital and ICU and we need oxygen and they want to give you a mask, they're going to give you probably one of four in the planet. Like that's, a doctor's not going to say, oh, that one's 10% cheaper. Let's give that one a go. It doesn't work like that. Like, a doctor's there to make sure you survive and you need oxygen, so give me the mask that's going to work, and it's going to be one of four products on the planet. That's like, wow. Like, and if you export that into a different market, it's going to be the same thought process that goes on in your brain as a human being, and therefore the outcome's going to be the same. So that's the lowest risk. When you go into new markets with new products, that's when it's a bit more risky. And then if you do M&A, WiseTech's a bit different because it's going onto the same platform, but generally that's the higher risk format. But if it's going onto a platform and it's going into a whole lot of the same processes, which is what WiseTech's done, then that's why that works. But generally the acquisition model is probably the highest risk. So you kind of got those three sort of high risk, medium risk, and then low risk kind of approaches. Yeah.
So James, we want to do a bit of a deep dive on a couple of stocks in the fund to kind of illustrate the philosophy that you've just spoken about. You've bought two today, ResMed and Moncler, both of which you've alluded to throughout this conversation. So let's start with ResMed. Can you just give us a quick refresher on what the company does?
So ResMed works in, I guess, airways management systems. So they'd have different markets, but there's CPAP, and they basically you use masks. That's what they do. So when you need oxygen in ICU or you have sleep apnea, then you'll need these mask kind of systems. It is very unique in the sense, and they also made an acquisition that provide a lot more digital and a lot more like app type formats, so you can get a lot more data as a customer and as a doctor to track what's actually happening. Again, it's a great business. I love it. It is high quality. Like I said, you can fit that industry on the palm of your hand. There's only probably 4 or 5 in the industry that actually does that, and doctors kind of trust them quite deeply. High ROE, large moat, very steady return profile, very consistent through COVID as well, quite consistent. And that's why, we've owned that one. We bought it recently because of GLP-1 sort of fear and scandal of GLP-1 has meant that stock had fallen quite a lot.
Yeah.
Quite a lot. But those markets are still there, and they are sort of going through that recovery phase in terms of multiple.
So, as you said, pretty well-known business. But what was the moment when you thought, oh, there's something here, I might want to add it to the fund?
I've had it in the Aussie fund for a lot of years, and it was just really the opportunity, the GLP-1, that made it a lot cheaper. So we bought it in the global fund.
It was a price story.
Yeah, it was a price story for ResMed, but because it all ticked the boxes on market structure and all that, that's why it was quality business.
And for people who aren't super familiar with that story, it fell about a third.
Correct.
Because there was all this fear that these GLP-1 drugs like Ozempic would reduce the amount of sleep apnea as people were losing weight.
Yep.
And so, companies like ResMed were sold off. But then since then, it's rebounded pretty strongly, hasn't it?
It has rebounded, and the GLP-1 phenomenon, I think it's still around. I just think the fear of it and the clear runway of it, creating such a very significant impact on obesity and sleep apnea has now been, that fear has been moderated, and that's meant that ResMed has been allowed, to recover by the market in terms of multiple.
And so we've been talking about like long-term reinvestment and stuff like that, and I'm just looking at their price chart, and their price is sort of similar to pre the GLP-1 scare.
Yeah.
So was the thesis, I just want to own it until it recovers, or is there a long-term investment thesis?
We're happy to own it longer term now, because it is a long-term growth story. It is a captive market, a high-quality business, and we still like it longer term, so we still own it. Nice. Still holding.
What are the risks to it then if you're thinking about, what are the risks to it?
Risks are always competition and also reinvesting. And when you start reinvesting in that reinvestment rate starts to fade. So you can't find reinvestment options that give you a high return. You end up reinvesting at a lower return. If we start to see those things, then you start to get more worried, and then you start to question that quality paradigm in your head that maybe it's not as great quality as you think, or maybe that sustainability runway is shorter than you think, which is what the GLP-1 fear was all about. It brought it in. So instead of being a 30-year story, maybe it's only a 10-year story.
Yeah.
So that's where I think you still need to be, really listen to management and see what they're saying, but then also listen to doctors and see what they're really saying about the product outlook. And that's, I guess, what you need to keep looking out for.
So for context, I've just pulled these numbers up from the National Institute of Health.
Yeah.
Obstructive sleep apnea affects approximately 20% of US adults, of whom about 90% are undiagnosed.
Yes.
And for me, that's always the stat that stands out when we talk about sleep apnea, just the amount of people that have it and the amount of people that don't know they have it.
Yep.
And so for me, it's like, why aren't ResMed reinvesting in a massive outdoor advertising campaign?
Yeah.
Are you sleeping poorly?
Yes.
20% of adults have sleep apnea.
Yeah.
Get tested today.
Yeah.
That's your reinvestment plan, right?
It's a very fair point, because your penetration is the key thing. A lot of the hearing's about the same, like for Cochlear and things like that as well. But for ResMed, it's just awareness. It's just awareness of these things.
And, so my dad has a ResMed CPAP machine, and his sleep is heaps better. And it's like the amount of people that could be sleeping better.
Yeah.
It's crazy.
And there's other benefits, it extends your life, extends your health, reduces a lot of other health risks as well, because your oxygen levels do fall very low for a period and then they come up again.
Or you stop breathing.
Yeah, you stop breathing. I mean, it's fundamental oxygen to the brain. So it's a big awareness campaign that they could keep investing in. That's what it's a really big penetration story.
Yeah. All right. Well, ResMed, if you're listening, we're happy to be your marketing guys.
Yes.
So that was one of the two stocks. The other stock was Moncler.
Yes, that's a luxury European brand, very aspirational. $2,000-$3,000 jackets that are very functional, very fashionable. Had origins making a Moncler jacket for guys that were conquering a mountain many years ago, and has now become one of the icons of if you wanted to kind of conquer the mountains and survive in the very cold conditions, Moncler is a very chosen brand. It's very fashion forward as well, so it's sort of over time has become a lot more fashion forward, but also a lot more functional, or they call it technical in the industry. So it's technical, functional, and also fashionable. But the prices they pay are like they're up there, like £2,000-3,000 jackets are very expensive, and that's why it's been around for 50, 60 years, is a phenomenal brand, very aspirational, and its return profiles are quite phenomenal, 20, 30% return profiles, and fits in all of that sort of LVMH kind of product range or product suite or product psychology of that kind of suite of assets. But it is separately listed and as set up by the founder, and is still a founder-led business and by the family.
So a business that's 60, 70 years old, quite mature, what's the growth profile over the next decade? Where do you see this business going?
Growing, yes, It's a fair question. So obviously with most fashion items, they have one sort of lead product and then they go into accessories. So you accessorize the range. And that's what they've done. So over the decades, they've accessorized the range to give them a more product range. But you fundamentally need a new demographic group to continue to grow, which in their case is really European wealth, but then also Asian wealth. And the Asian wealth has been the biggest source of growth, incremental growth, for the last about 10 years.
Right.
So it really is about those wealthy Asian markets in China that are moving upwards in the wealth sort of scales, and then they're using aspirational products, much like the consumption of Ferraris and BMWs. Moncler is no different. It's in that luxury camp where they are aspirational products for those that are in those wealth categories and going up the ladder. They are being consumed by those markets.
I want to jump in on that answer and also offer an answer to Bryce's question. I've just pulled up their financials. Last 5 years revenue, these are in euros.
Yeah.
1.4 billion euros 5 years ago. 2.98 billion euros 5 years later.
That's doubled.
Okay.
Yeah.
What do you expect over the next 10 years?
That compound, double-digit growth rate has been what they've done. That's what we're expecting them to do from European growth and the Asian growth market. And then that's the revenue line. And then you've got margins being maintained, and sometimes they're incrementally growing depending on what product range they have. So that's pretty phenomenal. Like as a business, that is quite phenomenal.
Yeah.
Just even to get double-digit top-line growth on that's 5 years, but to do it over 50 is mind-blowing.
Yeah.
And then to actually hold your brand and present that in the marketplace where it's still desirable every year for 50, 60 years, it's quite phenomenal.
What's their profit?
So it's quite consistent. Yeah, it's quite consistent margins.
Five years ago, it was 332 million euro. And then 612 million euros, so about
it's
double
quite
as well.
consistent.
Yeah.
So so very steady. That's what was that quality sort of comment that we spoke about before. Is very steady, very consistent, and very persistent. So like you look at that over 10, 20, 30 years, it's very persistent across those time periods, which, like I said, is phenomenal. Like in a world where everyone's trying to eat your lunch and trying to compete and innovate, and these momentum stocks come in with new ideas and try and create new things, it's quite phenomenal to be able to see a company like this over 10, 20, 30, 40, 50 years just doing that double digit returns, top line, bottom line.
So if that's the thesis, that it's got like a strong brand and strong market position, it's opening up new markets and new customers in terms of like a younger demographic in Asia, and then it's expanding its range with new accessories and stuff like that. What are the risks to that thesis, and what are you really monitoring as an investor to be like, that's going to be a red flag that I might sell? Yeah.
Typically with these luxury brands, it's some sort of a scandal. So look, much like any healthcare or engineering or consumer product, there's a lot of trust in the brand. And if consumers lose trust in that brand and respect for the brand, they effectively lose respect for themselves consuming that product. So whether it's a scandal in terms of how they run their business, so they have a lot of like ESG awards, Moncler, in terms of cotton, sustainability and etc. So those things are very, very important for their business. But if there is a scandal on either supply, or employee treatments, or some sort of where there's credibility lost, anything along those lines, typically it's supply or product, then that's when you start to lose credibility. And what happens first is honestly, it's happened so many times. Earnings will come off 10%, but the multiple can come off 30 or 40. So then your stock literally halves, and it's only on 10% earnings. So there's a lot of these quality businesses, especially, a lot of it's the values in the terminal value, which is in the future. But the multiples are high generally because there's a big trust element.
Yeah.
That'll be sustainable over years. So when that comment is not sustainable, then that can be, a stock can go from 30 times to 15 in a flash.
Yeah.
And that's what you need to keep your eye out for. So you've got to watch what management says, what they do, particularly what they do or what they say. So their behaviours, products they bring out, controls that they have on their brand, controls on their suppliers, controls with their employees, how they treat their employees, etc. So all these things are incredibly important for that multiple to be sustainable and those return profiles to be sustainable. So when they're not, it's a major problem. So that's why you've got to constantly keep an eye on these things.
Now, James, before we wrap up, I got to ask, we're talking about global future leaders here. We can't go past AI.
Yes.
Are you making any investments?
We are, but because AI is typically with the mega caps, so you need a huge amount of data, a huge amount of resources, and a lot of capital. Like some of them are spending hundreds of millions on this. Yeah. There's not a lot, but there is quite a lot of picks and shovels AI. Yeah. There is a lot of AI within our technology businesses that are either facilitators or users of AI, or they're using AI as an element within their own business. So there is quite a few, like NICE is a technology, which there is an AI app within that business, and there's a lot of facilitation of AI through all the software companies that we own, but there's not a lot you direct AI investment because most of that is mega caps. But it's a massive topic.
In the universe.
It is a massive topic, and when you go to the States or you talk to it's AI revolution is really what it is, and it is going to change our world. There's a lot of concerns about it, but it will revolutionize what is done in many businesses all around the world.
What was that company you said? NICE technology?
NICE, NICE, NICE. It's an Israeli technology company.
Okay.
And they've developed an AI, got an award actually for an AI development program that they did.
Cool. All right.
Haven't heard of them. Yeah. Another one to Google after this conversation.
Yeah. Well, James, thank you so much and congratulations on the launch of the ETF. We've had you on to discuss the fund before, but the Fidelity Global Future Leaders Active ETF is now available. The stock ticker is FCAP. And backed by 50 years of investment experience, Fidelity's new range of active ETFs not only cover the global future leaders, but also India, Asia, and a concentrated Australian equities ETF as well, which puts their 400 investment experts at your fingertips. The Fidelity Global Future Leaders Active ETF is issued by FIL Responsible Entity Australia Limited, AFSL number 409340. This is general information only and is not intended to be advice of any kind. Consider the PDS and TMD available at fidelity.com.au. And everything will be there. But James, as always, absolute pleasure. Thank you for coming on again.
Thank you both very much. Thanks, you. James. Thanks, heaps. Thank you.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.